Everybody agrees. I mean, even you go on the Federal Reserve's website and you look for the attributes of what is money? What does money have to be? And the very first thing is a store of value. And after that, they go medium of exchange, unit of account, and all these other things, fungible, indivisible, and all that other stuff. And so I came up with a couple of questions that you can ask somebody. If somebody is insisting, no, you're wrong, the euro is money. No, you're wrong, the dollar is money. Ask them, does money have to be a store of value? Is that one of its attributes? And if they say yes, ask them, is there inflation? And if they say yes, then ask them, aren't those two things mutually exclusive? If there is inflation, it is not storing value. And national fiat currencies, all of them on this planet now, are borrowed into existence and they're owed back plus interest. But the currency to pay the interest doesn't exist yet. It wasn't borrowed into existence. When it is borrowed into existence, you owe interest on that. So if you start off with $1 and you're going to owe that plus $1's worth of interest, and then you borrow the second dollar to pay that interest eventually, now there's $2 in existence. One is disappearing into the debt payment, but now you've got $4. There's $2 of interest and $2 of debt, and $1 is vanishing to pay off the principal on the first loan. Whenever you borrow currency into existence, whether it's from a bank or whether it's the central bank doing it, the currency appears as a double entry bookkeeping thing. There's a debt and a credit, and these two things. When you make payments, you're extinguishing the debt that is owed on that balance sheet with the currency that you save up. And so the principal vanishes, but the interest is still owed.
Mike Maloney often points out that in our society, there are constantly more loans being made than are being repaid. He mentions that if you look at the M2 currency supply, about 90% of it is bank credit. He also talks about what happens when you go out to buy a house and need $1 million loan. According to Maloney, the bank reviews your ability to repay the loan, and if they approve, they have you sign a loan document. At that point, they essentially imagine $1 million into existence. The bank types that amount into your checking account, creating brand new currency out of thin air. But at the same time, a debt is created you now owe the bank for that loan. When you make payments on the principal, that imagined currency vanishes. However, you still have to save up some of the existing pool of currency, which was also borrowed into existence, to pay the interest. This interest is the bank's profit, which covers their expenses, including employee salaries and building costs. But as Maloney often emphasizes, the dollars you're paying with were originally borrowed into existence. They're actually someone else's principal that was brought into the currency pool. Maloney digs deep into the monetary system and describes it as an illusion. He believes it's crucial for everyone to start learning about this now because we're on the brink of enormous changes in the next few years. He often predicts that this decade will see significant upheavals in the monetary system and believes that gold and silver will emerge as the big winners. He also talks about the two forms of base currency. The first is the paper notes in your wallet, which are IS from the Federal Reserve if you live in the United States, the ECB if you're in Europe, or the Bank of England if you're in England. Maloney explains that these paper notes used to constitute the vast majority of base currency. However, due to the mechanics of quantitative easing, base currency has increasingly become trapped in the form of bank reserves.
Bank reserves are a dollar that the public never sees, touches, or interacts with. It is something that is only used for interbank settlement and interbank loans. So they're borrowing and lending to one another. And then if I pay you and I write a check to you and you go and cash that check, your bank is going to contact my bank and tell them that you've got a check from me, and they'll make $1,000 worth of the imagined bank credit currency digits, these dollars that are just digits, which the Bank of England actually states these digits are reminders that the bank owes you an IOU. They aren't even an IOU. The bank owes you the paper note IOUs, the base currency IOUs. So there's about $2 trillion worth of base currency IOUs that we use in circulation, paper notes. The banks use that for just interbank settlement. The vast majority of the currency supply, about 90% of M2, is bank credit currency. So these are, like I said, digits in your bank account that remind the bank that it owes you that many central bank IOUs. Today's fiat currency is a trade of nothing for something, which is a fraud. And, they're inventing digits that are reminders to pay IOUs. And when they do, it dilutes the IOU supply that is out there, the M2 IOU supply, and thereby steals purchasing power from all the existing units of currency. We saw that in the stock market with QE and the inflation. They don't measure there's something I came up with a long time ago called CUP inflation, CUPP, currency units per person, and nothing else really matters. In the long run, if the CPI also included the stock market, real estate, and so on, then they would get an accurate measure of inflation that reflected the growth of the currency supply. Because there is one truth: every dollar created has to go somewhere. If people can if they can discern the difference between currency and money, it makes a huge difference in your life, and it shows you how you are being robbed by the system.
Mike Maloney often talks about a concept he came up with a long time ago called cup inflation, which stands for currency units per person. He believes that, in the long run, nothing else really matters. According to him, if the CPI Consumer Price Index included the stock market, real estate, and other assets, it would give a more accurate measure of inflation that truly reflects the growth of the currency supply. Maloney stresses that there's one fundamental truth: every dollar created has to go somewhere. He argues that if people could understand the difference between currency and money, it would make a huge difference in their lives and reveal how the system is essentially robbing them. He often points out that the current system benefits the few at the expense of the many. Maloney also explains that when the Fed engages in quantitative easing QE, the mechanics of QE dictate that asset purchases can only be made through their primary dealers, which are these big brokerage houses. This process funnels currency directly into the stock markets. These primary dealers have the option to buy directly from the Treasury or from the open market. So, if the Fed decides to purchase bonds or mortgage-backed securities, and it happens to be from a pension fund, that pension fund might then choose to replace the bond with stocks. Maloney finds the correlation between the rise in base currency and the stock market to be astounding. He points out that during QE1 through QE3, if the base currency increased by 10%, the stock market would also rise by 10%. If the base currency went up by 20%, the stock market would similarly increase by 20%. He often highlights how remarkable these correlations are. Furthermore, Maloney warns that when the currency supply is diluted and the new currency is funneled into a particular area, that area becomes distorted. However, it's essentially robbing from other areas in the process. He believes this is what kept the prices of groceries, gasoline, and other necessities down for so many years. They had trouble creating inflation because the mechanics of their approach were primarily inflating the stock market, and that was the focus. 4.0